Okay, so if you're trying to buy a property right now and you want to know what loan program is the best for you, well, my name is Jorge. I am a real estate and mortgage professional. I'm licensed in multiple states, and I've been doing this for a very long time. And what do I explain to my clients is there's two categories when it comes to checking out what loan program is best for you. Now, I make it very simple. There are traditional loans and non-traditional loans, right? And the goal of any real estate or mortgage professional is to find out which program is best for you. Now, when we talk about traditional loans, we're talking about the conventional loans, FHA, VA, USDA, etc., right? These are the loans where you have to disclose a lot of information. They're considered full doc loans, full documentation. Why? Because you're providing your pay stubs, your W-2s, your tax returns if you're self-employed, if you own rental property. So there's a lot of information that you have to provide up front because it is considered a traditional loan. A lot of people offer this. Banks, direct lenders, brokers, credit unions, etc. Okay, they're very popular and they're your traditional loans. You can get this anywhere. Now, the benefits of traditional loans is the fact that number one, their interest rates are going to be lower, right? Because there's less risk for the investors because you're providing more information and they know who they're working with. So the interest rates are lower and the fees are going to be lower as well, right? Now, these are great loans, right? If you are a typical W-2 employee or you can document your income and you have 2 years worth of work experience, great. This loan program is for you, especially if you're a first-time home buyer, you're buying your primary home, even if you're buying a second home. This program or this category of loan products will definitely help you out. Now, on the other side, there are non-traditional loans. Now, these are alternative documentation or minimal documentation, sometimes no documentation to qualify to purchase a property. Now, this is tailored more for, I would say, investors, seasoned buyers. You can be a first-time home buyer as well. However, there are pros, as I mentioned, minimum documentation, right? However, what separates this from a traditional loan is you need more money down. You need more skin in the game, right? Starting at 10% down if you're buying your primary residence and up, right? You also have to have reserves, right? Reserves are additional money saved up. You're not going to use for this transaction, but you're going to have it there just in case in a rainy day fund, right? If something happens. Interest rates are going to be higher right off the bat. It can be anywhere between 0.5 point to 2 points higher. And when I say points, I mean interest rates, points, right? So for example, in a traditional loan, you might qualify for, let's just say 6% on a traditional loan, let's just say a FHA loan. But on a non-traditional loan, then guess what? It's going to be 6.5%, 7%, even 8%, just depends, right? So if you're buying a home under a non-traditional loan, pretty much if you're a primary resident, it's going to be 10% down. And if you're buying it as an investor, well, you can expect to put down as much as 20% down or more, right? A lot of benefits. I personally I work with a lot of self-employed home buyers. And the program that I like a lot, which is really popular, is a bank statement loan program. And really quick, what that is if you're a business owner, you file your tax returns every year, right? However, let's just say your tax returns aren't really indicative or represent your company to the fullest because you report a lot of losses. You're making money, but for whatever reason, you're reporting losses, right? You're being strategic. It's okay. We can use your deposits that you make every month to qualify your income so that you can buy a property. So picture that. You don't need to show tax returns. You don't have to show pay stubs, W-2s. All we need is your bank statements, 12 months or 24 months worth, and that'll be enough for us to use as income to help you qualify. There's a profit and loss program under the non-traditional loan program. If you're an investor, there are DSCR loans. So we don't even look at any income at all. All we care about is what the rental potential of the property you're trying to buy is going to be to qualify. And finally, there is a no ratio, basically that's what it's called. What that means is you don't need to provide any documentation. You don't have to, it doesn't matter if you're trying to rent it out. I mean, ideally you're trying to buy this as a primary residence, But as long as you put 20% down and you have enough reserves, you're going to qualify to buy this property. So we can get creative. I am a mortgage professional. I'm also a real estate professional, licensed in multiple states. If you have questions, do not hesitate. Reach out to me with either traditional loan questions or non-traditional loan questions. I'm here to help. Don't forget to follow the Home Equity Coach.